I'm here with Alec Young, the Managing Director of Global Markets Research at FTSE Russell. Thank you so much for joining us today.
Thanks for having me.
So it's a crazy day here in the markets. We've had quite the little sell-off happen here around midday. What do you think is going on? What's driving this mini market sell-off?
Well, I think today the focus is really on the Italian political situation, where we recently had elections and we've had a couple of non-establishment parties kind of come together to form a coalition. And some documents have leaked out that really show that there's some very anti-Euro views and Euro-skeptical views within that coalition, and that has markets a little bit concerned when you have one of the biggest countries in the Eurozone talking about, potentially exiting the Euro. The viability of the Euro bloc kind of gets called into question, and I think the long and short of it is, while there can certainly, you can have people in the markets extrapolating very negative outcomes because of this, I think it's more likely that we're looking at a situation where everything that's happened up until now is going to require new elections in Italy, and I think hopefully cooler heads prevail and we wind up with leadership in Italy that's a little bit more mainstream, and I think if that's the case, the current volatility that we're seeing, it would be logical to see that wind down a little bit. It's just that when people can see a path to a negative outcome in the markets, even if they don't think it's very likely, just that possibility can drive a lot of volatility, especially considering that this really wasn't on people's radar over the last few weeks. Things had been, relatively calm. Now we're seeing a real flight to quality into safe havens like government bonds, treasury yields falling, German bunds falling. We're seeing a lot of flight to quality, and part of that violent reaction is the fact that people just weren't expecting this. As recently as a week ago, when the conversation was more about rates going higher,
right,
not lower.
Right, and there's a lot to unpack here with what's going on in the markets today. I want to hone in here for a second on volatility.
Sure.
Even just today, the VIX is up some 24%.
Sure.
It's been wildly higher in the past year to date than maybe compared to 2017. Do you think that volatility is something investors need to be concerned about?
Well, I think clearly 2017 we had some of the best risk-adjusted returns in market history. So not just how much markets went up, but how little volatility went along with that. And this is really more of a mean reversion back to historical norms. Certainly today's volatility isn't the day-to-day norm, but I think having bouts like this is part of a normal market. Typically the market will see a couple of 5% pullbacks a year. We'll see a 10% correction every 18 months. Up until this year, volatility had really been subdued for a long time. So a lot of investors should really think of this as really more of a return to a normal type of risk-reward trade-offs in the markets.
Okay, we've had a handful of pretty decently sized macroeconomic geopolitical events in the past couple of weeks. China trade, NAFTA negotiations, now Italy, Spain. What does this mean for asset allocation from your perspective?
I think what we're really seeing playing out in the markets, just taking an objective look at the data, is really a focus more on being domestic, on being more U.S. oriented, and the way a lot of investors are expressing that is through small cap versus large cap. So small caps have been underperforming for several years quite significantly, but this year we've seen them really start to outperform. They have less overseas revenue exposure than their large cap counterparts. So the Russell 2000 gets about 20% of its sales from international sources versus a number in the low 30s for the large cap Russell 1000 index or for the S&P 500. And so anytime we've had this negative headline risk coming from overseas, as you said, whether it be China trade concerns, various geopolitical issues, NAFTA, now concerns politically in Italy, we've seen that as just another reason for small caps to outperform. The other thing that's really helped small caps is the fact that being more domestic, they're a little more leveraged to the president's tax reform agenda, the tax cuts, and also more leverage to deregulation. In fact, the Congress just did some Dodd-Frank rollbacks, really targeting relief for regional banks, smaller banks, and that has been another sector-level driver of small cap leadership this year.
Okay. Now, I know that bull markets don't die of old age, but if you had to pick what might be the mortal blow that ends this, more than 9-year run, do you have any idea what it might be? Is it going to be something macro related, geopolitically? What's your take?
Yeah, I mean, it's really always hard to tell. We're not so much in the forecasting business at FTSE Russell. What we're looking is just objectively analyzing the data. And looking at that, I think the fundamentals still look very solid for U.S. equities in particular, but even overseas. And I think what we're seeing here is really more increase in risk aversion, but from very low levels, whether it's the VIX, whether it's credit spreads. Yes, things are deteriorating a little bit here, but it's from very historical levels. The current levels of spreads, or even Italian bond yields, or the VIX, or any other measure of market fear. If you look at it from a historical perspective, the current levels are still relatively low. So I think there's certainly no sign in the data that the bull market is going to be threatened by something like that. I think the thing we're more focused on is really what's going on with corporate earnings, fundamentals, valuations, and when we look at all of that, there's no reason to think that the party is over, so to speak. The other thing that we're looking at is central bank policy and what's going on, not only in the U.S., but globally, and we still have very accommodative central bank environment.
Okay, and we are in a rising interest rate environment right now. Do you think that last week the big headline was 10-year yield above 3%? It's pulled back decently today, but do you think that this flight to these lower risk assets is going to continue, and how might the rising interest rate environment impact that move?
Yeah, I mean, I think it's interesting. We had concerns earlier in the year about inflation. Rates have been going up, and they've been pretty sticky to the upside. But I think this Italian political situation is going to be an overhang. Again, I think it's too soon to extrapolate the most negative outcomes. If we look at the numbers, you can actually see that German assets, for example, are holding up relatively well. The U.S. is holding up relatively well. So the market's being fairly selective. Yes, Italy is showing stress, but I think as we look at the numbers right now, there's really the most logical conclusion, I think, is that investors are concerned that there's a potential path to a pretty negative outcome in Italy. That doesn't mean that it's likely. It could be. I think it's probably 9 to 10 times more likely that something less negative happens, but just the fact that risk is now on the table is going to be a little bit of an overhang. So I think investors should expect more of a choppy environment until that gets resolved. But they should remember that doesn't necessarily mean an end to the bull market.
Okay. So let's turn for a second here to talk about U.S. trade. How do you think the broader market, the global market, has responded to the way the U.S. is going about trade deals, both with China and with our negotiations when it comes to NAFTA?
I think it's been a bit of a double-edged sword. On the one hand, it's obviously an unconventional approach. It's a more aggressive approach than we've seen from prior administrations. On the other hand, it is bearing fruit in the sense that we are seeing some back and forth and some compromise. I think the fact that the U.S. Secretary Mnuchin has said that the $150 billion in Chinese trade tariffs are on hold for now. The Chinese have cut the import tariff on U.S. cars to 15% from 25%. I think the market liked to see that conciliatory tone on that front. It's been a little harder to get progress on the NAFTA front, so the jury's still out there. People are obviously watching that closely, but as long as it's a sort of a healthy dialogue between the two sides, where you have like comment periods where companies can kind of weigh in, where it doesn't seem like it's being driven in a very emotional, sort of haphazard way. I think the market is comfortable with increasing trade protectionism. It's worth pointing out that if you look at the stimulus from the tax reform, the fiscal stimulus that's in the pipeline, it's actually much bigger than any potential headwinds from trade that are currently on the table. So we also have a Fed that I think is pretty committed to gradual rate hikes. We have corporate fundamentals that are otherwise very healthy. So when you look at it in that context, I think the signs from the markets are that the trade negotiations are going to be manageable.
Okay, and from a corporate perspective, we had a very strong earnings season for Q1. Do you think that the market priced in that momentum enough, or do you think that it was a sort of maybe a muted reaction?
I think the concern in the markets, obviously the results were great. I think the concern is, can it get any better from here? And on that front, what we're focusing on is yes, the growth rate, which came in, in the mid 20% year over year for large cap earnings growth in the first quarter. That's going to be hard to continue to build. 25% is a very big number, the growth rate may slow, but the actual level of corporate earnings will continue to climb. It'll just be growing at a smaller clip. So I think that realization drove a little bit of the volatility we saw earlier in the year. But I think one of the reasons that stocks have been relatively resilient in the face of all these macro issues is the fact that the corporate environment is very, very healthy. There's no reason to think that we're not looking at continued increases in corporate earnings as the quarters continue here. So it's actually very helpful that a lot of these global macro headline risks are coming at a time where the domestic fundamental picture is healthy. It makes it easier to handle a lot of these potential macro risks.
Okay, and finally, aside from just small cap versus large cap, international versus domestic, are there any sectors you're looking at that you're particularly see a lot of momentum coming there, you're bullish on moving into the end of this year?
One thing that we have seen pretty consistently is cyclicals doing better than defensive. So not really in the forecasting business, it's more about what's the data telling us, but certainly we've seen a bifurcation, whether it's performance, we've seen better performance year to date from cyclicals, technology, financials, industrials versus telecom, utilities, real estate. That cyclical defensive differentiation is flowing through in terms of performance, but also in terms of fundamentals. If we look at earnings revisions, if we look at a lot of the revenue trends, the cyclicals have a better story to tell. And also when we look at valuation, they're also screening more favorably there. So I think at the sector level, cyclical, I think, has certainly been the way to go so far.
All right, thank you so much, Alec Young from FTSE Russell.
Thank you.